This lecture is about cash flow statements, or statements of cash flow, depending on which way you want to show it. The reason we have a cash flow statement is because our income statement is calculated on what we call the accrual method, which means that we report revenues whether or not we've been paid, and we report expenses whether or not we've paid for them. So what the cash flow statement does is it separates that out and only reports the cash coming in from customers, whether it's money billed this month, this year, or some other year. It reports cash going out to your suppliers, once again, whether it's for this year, last year, this month, or whatever. It's just the cash that went out in this time period. So it allows you to take a look at your cash flow compared to your profitability. Both of those things are important. You have to make money in order to have cash flow. But what happens to people sometimes is they focus on making the sale and not so much on making the collection of the sale. So this statement allows people to monitor both cash flow coming in and the profitability that they're looking at on the income statement. So we divide it up into three different categories: operating, investing, and financing. The operating is by far the most important category in the cash flow statement because it shows you in your core business where the money comes from, where it goes. The money you get from customers, the money you pay to suppliers and employees. The purpose of this statement is, of course, to predict future cash flows. You can see that if you're getting this much money in now, well, you should be able to collect a similar amount if your sales are similar, next period. It helps you evaluate management decisions. Sometimes we make different decisions around credit policy. We're going to try let people pay us later. Will that increase sales? You'll see that benefit on the income statement, but in the cash flow statement, if you relax your credit policy, you'll probably see less money coming in because you're selling to people that don't have as ready access to paying their bills as you did before. Creditors look at this cash flow statement to determine if you've got enough cash flow coming in to pay them. They want to see that you've got positive cash flow because your profitability talks about making interest payments. It's only the cash flow statement that covers the ability to make principal payments. Now, we'll talk more about this later, but when you make a payment on a bank loan, part of it's principal and part of it's interest. The interest shows up in your income statement, the principal shows up in your cash flow statement, but you got to have enough money to pay both. So we look at the cash flow statement for that purpose. This helps us understand the difference between net income and cash flow, because we've got the two separate statements. So operating activities, as I've said, these are the items that create cash flow in your operations. So money coming in from customers, money going out to suppliers. When you look at investing activities, this is the long-term assets section of the balance sheet. During this course, you're not going to have to prepare a cash flow statement, for which you might be grateful. But if you were going to prepare one, you would account for the differences in the long-term asset section on the balance sheet in this section on the cash flow statement. So when you buy fixed assets, that's cash flowing out of your business. When you sell fixed assets, the amount of money you receive, the proceeds on that sale, that's cash flow into your business. So what you would see on the income statement for the sale of a fixed asset is the gain or loss. What you see on the cash flow statement is the actual cash you receive, the proceeds. And again, we'll talk more about this later too. So the investing activities are about buying and selling assets, the long-term assets. Your financing activities are when you borrow money, that's cash coming in. When you pay money back, that's cash going out. So those are the two things you normally see under financing activities. And this is the long-term liability section of the balance sheet that's accounted for here. So when you're looking for money, you're looking to reduce your current assets like receivables. So collect your receivables, sell your inventory. You also could use a method of buying things from your suppliers and not paying them very quickly. That increases in your accounts payable actually provides you with cash because you're selling the item you bought and you haven't paid them yet. You also can borrow money. Long-term financing will bring money into the organization. And my personal favorite is to have positive net income. If you are selling everything you make at a profit, then you will see cash flow. You use cash the opposite of that. When your current assets are going up, your receivables, your inventory are increasing, that's using up your cash. And typically if someone's making money and they don't have any money, it's because they haven't been paid by their customers or they've invested in additional inventory. You use cash when you pay your creditors. You use cash when you pay dividends. So if you are paying out more dividends than you're actually earning, well, of course, that will reduce your cash flow because that's money leaving the business. And losing money, of course, reduces cash flow. So this example is what a cash flow statement looks like. At the top, you see cash flow from operating, which is the cash that came in from customers, less the cash you paid to suppliers and employees. A minus means it's cash going out. The absence of a minus means it's cash coming in. So this business has positive cash flow from operations of almost $55,000. What did they do with it? Well, they spent a lot of it paying back debt. So their negative cash flow from financing, paying mortgages, paying bank loans. They also pay dividends. They have as much cash going out to pay debt as they had coming in from operations. Their cash flow from investing is negligible. They have negative cash flow because they've bought a few fixed assets and a few patents, very small numbers. So you would assume, looking at this cash flow statement, that this is a mature business. They don't need to be investing. They are focusing on paying down their debt. The bottom of the statement, as I've said before, ends with the cash that shows on the balance sheet. It has a comparison to the cash that showed on the balance sheet last year, and the increase or decrease in cash is accounted for by operating, financing, and investing activities. So this lecture was about cash flow, understanding what the cash flow statement is telling you, which is where did your money come from and where did it go.